Hey guys, welcome to Lumovest. In this video, we're going to talk about why you should avoid buying penny stocks. It's a very common investing pitfall that victimizes lots of investors. People have lost their entire savings in penny stocks, and we'd hate to see this happen to you. Before you forget, subscribe to our YouTube channel so you get our latest and greatest videos helping you become a sophisticated investor. The United States Securities and Exchange Commission, or SEC, is the government body overseeing the U.S. stock market. It has repeatedly warned investors about the danger of investing in penny stocks. Here's a snippet where they warned investors that you may lose your whole investment in penny stocks. A research analysis done by the SEC of 1.8 million trades made by over 200,000 individual investors found that most people lose money investing in OTC stocks, that you're twice as likely to lose money than to make money. The SEC analysis also found that the typical investment return is severely negative. Not just negative, but severely negative. Meaning, investors who invest in penny stocks tend to suffer severe losses. And the reason is really because penny stocks are extremely risky. First of all, penny stocks lack transparency. The companies underlying these penny stocks don't file periodic reports like their counterparts listed on major stock exchanges do, such as the New York Stock Exchange or the NASDAQ. Meaning, investors don't have sufficient transparency into the underlying companies that they're investing in. Recall that when you invest in a stock, you're really investing in the underlying company because you're buying a piece of ownership in that company. Your investment grows when the company you invested in succeeds in business, earns more profits, and becomes more valuable. When this happens, your ownership stake becomes more valuable. This is investing. But with penny stocks, it's more like gambling. You don't know enough about the underlying company to form a view on whether the business will succeed. The penny stock company you invest in could very well be losing a ton of money and about to go bankrupt. And you wouldn't even know. This lack of transparency is a major risk. And second, penny stocks have very low trading volume, meaning that they exchange hands infrequently. When you buy a stock, someone else has to be willing to sell theirs in order for the trade to happen. It's easy to buy the penny stock. The problem comes when you need to sell. Because penny stocks are so illiquid, you might not be able to sell the stocks because there might not be any buyers willing to take the stock off your hands. Getting in might not be a problem, but getting out is. And if you really want to sell, well then you might have to offer a much lower price to attract buyers, which can create significant losses to you. Worse, there are lots of scammers who would promote the penny stocks that they own on the internet, luring investors into buying the stocks. They make you think the company is the next Amazon, when in reality, it might not even be operational. This buying demand increases the stock price. Then, when the price gets high enough, the scammers sell their shares, making them lots of money but causing the stock price to fall and leaving innocent investors trapped with losses. This happens all the time with penny stocks. We've all heard of people who made lots of money from penny stocks. But what we don't hear as often as we should is about the hundreds of thousands of people who lost their money from penny stocks. There are people who've had their entire savings wiped out by penny stocks. Remember, according to the government findings, you're twice as likely to lose money than to make money, and chances are you'll suffer severe investment losses. You're literally tossing your hard-earned money down the drain with penny stocks. So do yourself a favor and stay away from penny stocks. Avoid them like the plague.